Leverage only works in a large professional accounting firm. This allows for attractive compensation of partners. Typically, leverage involves a markup of between 8 and 10 times the salary of subordinate staff. When I was promoted to senior manager at PwC in Vancouver in 2009, I was paid about $60 an hour, including bonus, and billed out at $5.75 per hour. Utilization was expected to be in excess of 90% if you wanted to earn your bonus. Traditionally, large audit firms were able to focus primarily on the audits of big public companies and built their brands as a result of their association with these large companies. Since accountants had been granted a monopoly to perform audits, their continued existence had seemed assured. In an appropriately balanced firm with an adequate number of ambitious juniors, partners could be well compensated and junior staff could theoretically achieve work-life balance. However, changing demographics and a changing business environment have made this difficult. When management consulting guru David Meister began to write Managing the Professional Service Firm in the late 1980s, there were almost 3 times as many university-aged persons as seniors. Today, that demographic has flipped. In addition, accountants have relied on the audits of well-known public companies to build their brands internationally. However, since the mid-1990s, the number of large multinational public companies has been in decline. Consequently, large accounting firms have begun to diversify into management consulting work. In order to maintain access to a pool of relatively low-cost junior staff, the big firms have influenced the profession to redraw the competency map required of junior staff. Small firms focus on taxation and compilation work almost exclusively because that's what their clients value. This has effectively eliminated most of the more than 18,000 small firms from the competition for entry-level staff. If they can't hire staff, leverage can't work for them. Simply put, they cannot train junior staff to meet the experience requirements to earn their designations, and they can't afford to train them for the benefit of the larger firms. In spite of this, small professional firms can still be profitable. The charge-out rates for junior staff in large firms are so highly leveraged that practitioners in small firms can make a decent living by doing the work themselves at reasonable rates. For the small firm, leveraging people doesn't work. Instead, they must do a better job of leveraging technology to collaborate more effectively. So-called juniors should aspire to be independent technicians whose work facilitates the professional. They should be able to earn as much or more as subordinate professional staff in large firms. Meanwhile, independent professionals are free to perform higher level work at a fraction of big firm charge-out rates. While at SBA Canada, our focus is on the accounting profession, we believe that smaller professional firms in both legal services and consulting should probably revisit their business models as well.